I wrote this book back in 2009. It's called Crash Boom. And as I'm looking at the situation we're in the middle of right now, I'm kind of obsessed with the idea of how does it play out? How does, as a business, as a human being, how do I prepare for, position myself in the business for what's going to come next? And nobody knows, but history can be a teacher. And this idea that, I was like, hey, wait a minute, I already wrote about this. This book was written during the Great Recession, and it was all about researching the Great Depression, including talking to people that lived through it, which is the coolest part of writing this book, but trying to understand if these economic phenomenon, well, let me start with this. They do follow a certain pattern, okay? And the Great Recession followed a certain pattern that was very similar to the Great Depression. And so when I wrote this, it was only half baked, right? We were in the middle of the recession. The recovery hadn't happened. The crash had happened. The boom had not yet happened. I'm trying to understand how that plays out and what it looks like is what this was all about. And so I'm in that spot again now. And here's what I learned last time and how I'm sort of framing it now. These things happen where some economic event takes place, and then there's a human response to that economic event, which then creates another economic event, which then creates another human response. And we have this ping pong match that goes back and forth. And it looks something like this. Whatever kicks off a recession, the first response by human beings is to dump their stocks, right? So the stock market takes a hit, which of course we saw a few weeks ago here, a pretty deep, pretty hard hit. But then that creates another human response, which is usually consumer confidence goes down. And when consumer confidence goes down, the behavior pattern is they stop spending money. Either they don't have it, or they're hoarding their cash, keeping their powder dry. They stop spending money. Businesses begin to see fewer people on the website, fewer people in the stores, fewer people buying things, et cetera, et cetera. So the business confidence goes down, and their reaction then is to hold back on hiring and begin letting people go. As time passes, unemployment begins to go up, right? Makes sense. A little bit further down the line, you see that the buyers have stopped buying homes as part of this consumer confidence and employment erosion. And then eventually the sellers begin to get the message, right? And when you see home sales decline for a period of time, eventually if a seller wants to sell a home, the seller is going to have to lower their price. So then you see home prices coming down. And the thing about it is that this usually takes place over a 1 to 2 year period, right? Right? You've got these different things happen, and there's a stimulation of a human response, which then plays out to the next reaction, the next event, and it takes place over 12 to 24 months, right? But what happens when the initial event is something like not of this world, right? Where you've got a pandemic that comes out of nowhere. Well, what's happening right now, it looks like, is that everything is compressed. Stock market went down, unemployment went through the roof like 2 days later. Right? Consumer confidence flattened out. Consumer spending went to a fraction because like literally businesses were closed, right? Travel and tourism shut down. Restaurants shut down. People have to stay at home. So all these things are happening. What would have otherwise been a year to 2 years appears to be happening over an 8-week window, a compressed recession. But as I said before, crash boom is the thing. The crash is only half of the thing. The boom is the other half. The recession and the recovery are two chapters from the same story, right? And so when chapter 1 is a compressed recession, the question is, do we then get a recovery that matches the pace and the duration of the recession? So do we see the stock market bounce back up again relatively quickly? I don't know. Do we then see consumer confidence right behind it, and then business confidence right behind that, and then home sales and home prices all recovering practically overnight? This is what you hear people talk about when they talk about a V-shaped recovery, right? It goes down, it bounces back up again. Or a U-shaped recovery, where it goes down and hangs down there for a bit and then comes back up again. What I'm seeing here reminds me of what I watched very closely during the Great Recession. It reminds me of what I learned about over the Great Depression, which was way stretched out over practically a decade back then. And we're looking at it all happening in a tight time frame like this. So what does that all mean? It means that the people who are talking about this thing passing at some point and then the market recovering rapidly, what does that look like? It looks like a party. It looks like the party of the century. Like, I'm not going to cook another meal until the end of the year. If this thing opens up in the next month or so, I'm just going to restaurants. I'm taking everybody out, right? And I think everyone's going to have the same kind of reaction. So I do sense that the consumer response on the other end of this is going to be just as sharp as the consumer response on the way in. And since I believe that the human response to all of these things are what create the ups and the downs in all these things, it gives me a lot of confidence. So recently somebody asked, I put these slides together. They seem to like it. I wanted to share it with you. Thanks for watching.